Whoa, something just shifted in the financial markets. After things being pretty calm for a while, it's like everything turned on a dime. And it all seems to point back to one big thing: a growing fear of a long, drawn-out war. So let's unpack exactly how that fear is causing this major sell-off.
Okay, and this is the number that's sending a shockwave through everything. It seems to have come out of nowhere, but some investors are now actually betting that US inflation could jump above 5% in the next year. Now, to be clear, that's not a guarantee, but just a few weeks ago, a number like this wasn't even part of the conversation. The fact that it's on the table at all has sent a jolt of pure anxiety through the financial world.
And yeah, it's already making headlines. Both stocks and bonds are taking a real beating. The key thing to understand here is that the market isn't just a little nervous, it's actively pricing in the possibility that this conflict has no clear end in sight.
So, here's how we're going to break this down. First, we'll look at the markets on edge and the data behind the fear. Then, we'll dive into the war's economic shadow. After that, we'll look at what's being called the Trump gamble, trace the inflation domino effect, and finally, we'll connect all this political action directly to what's happening in your portfolio.
All right, let's kick things off with Section 1, Markets on Edge. Let's look at the hard data that shows what this fear actually looks like in the real world. And look, this is not just some minor dip. The stock market is hitting brand new lows for the year. What this tells us is that investors are really struggling to figure out just how long and how damaging this conflict could be. And right now, they just don't know where the bottom is.
Now this is where things get really wild. Check out the massive shift in what people expect the Federal Reserve to do. Not that long ago, everyone was talking about potential rate cuts. Now, traders are pricing in a 50-50 chance of a rate hike by October. Rate cuts are completely off the table. That is an absolutely insane reversal in such a short amount of time. Okay, so we've seen the what of the market's reaction. But what about the why? That brings us to Section 2, a war's economic shadow.
You know, at the very core of all this market panic is this one idea: a protracted war. We're talking about a conflict that just drags on and on, with no obvious end in sight, creating this constant cloud of uncertainty and economic chaos. And this specific fear, well, it's the engine driving this entire sell-off.
And this puts central banks like the Fed in an absolutely impossible position. What do? Do you fight the slowing economy, or do you fight the new inflation that's popping up because of the conflict in oil prices? With no clear winner in that fight, their next move is incredibly hard to predict. And if there's one thing markets truly hate, it's that kind of uncertainty.
So this uncertainty isn't just popping up out of thin air. The sources suggest it's being fueled by a pretty specific catalyst. That brings us to Section 3, the Trump gamble.
Let's start with President Trump's own words describing the situation. He calls it a simple military maneuver and says the enemy's key assets like their leadership, Navy, and Air Force are gone. This is the official story being presented. Everything is basically under control.
Okay, but here's where the anxiety really kicks in for the markets. That official narrative is clashing, big time, with what military analysts are saying. What's being called simple and safe by the White House is being described by these experts as carrying substantial risk with no obvious next step. This huge gap between the official rhetoric and the expert analysis is a major source of confusion and fear.
And it's not just talk, right? The market is also looking at concrete actions and reported plans. We're hearing about heavy preparations for ground troops, talk of seizing a huge oil hub, sending thousands of more Marines, and then a public statement rejecting a ceasefire. To an investor, these are all flashing red lights that this conflict could be getting bigger, not smaller.
So how does all this geopolitical tension actually translate into real risk for the economy? Well, that brings us to Section 4, the inflation domino effect.
Here's how the dominoes are falling, one by one. First, the idea that the conflict is escalating causes global oil prices to spike. That spike immediately fuels fears of inflation coming back. In response, traders start betting that the Fed will have to hike interest rates. And finally, the thought of higher rates for longer makes both stocks and bonds look less attractive, and you get a sell-off. It's a pretty clear and logical chain of fear.
And this isn't just guesswork. You can literally see the math that's got people worried. The models show a direct link. As the price of oil climbs from $95 a barrel up toward $150, the predicted inflation rate just marches right up along with it, from 3.2% all the way to 4.3%. This is the cold, hard data that's fueling the market's anxiety.
All right, let's tie this all together in our final section, connecting politics to portfolios. So, if you take one thing away from all of this, it should be this. The market isn't just spooked by some vague, abstract geopolitical risk. No, it is reacting in real time to very specific words, very specific plans, and very specific military movements that it believes are pointing directly toward a long, costly, and inflationary war.
And that leaves all of us with a pretty powerful question to think about. It's not just about earnings reports and economic data anymore. The question we all have to ask now is just how much geopolitical risk, driven by the words and actions of a single leader, is priced into our financial future?